What is good, fellas? Today we're going over golden bucket, right? This golden bucket. Not only that, but we're also going to go over Fibonacci. And what that means. What is a Fibonacci? How does it work? Why does the market respect it? All the basics, everything you need to understand on why it works, how it works, where you can find it, how you can use it. And then I want to go over a strategy and how you can use this strategy, aka the Fibonacci tool, to take setups in the market. So now we're starting to build this little foundation block that I've been talking about. Like now you know about market structure, liquidity sweeps, you know about fair value gaps, you know about initial balance, you know about all these little things. So now we can start using those things that tell us where the market wants to go to find a precise entry to follow the trend to where it wants to go next, if that makes sense. So number one, why does Fibonacci work? Let's keep this extremely simple. Fibonacci is a mathematical sequence found in nature absolutely everywhere, being flower petals, galaxy spirals, seashell patterns, human body proportions, weather patterns, and yes, the financial market. The sequence is basically based off this. It's 1, 1, 2, 3, 5, 8, 13, 21. Each number is the sum of the 2 before it. I'll explain this shit to you guys. It's 1, 1, and it's why do you guys care? You guys don't give a shit what the Fibonacci sequence is. But the magic, it comes from the ratios inside the sequence of 0.382, 0.5, 0.618, and 0.786. The most important one being 618. That's essentially the golden ratio. This ratio appears basically everywhere in natural growth and movement. Markets, which are driven by human behavior, follow the exact same rhythm. This is why Fibonacci works, just simply because it reflects natural cycles and natural corrections. Now, why does the price react to these Fib levels? There's two main reasons. Number one being psychological behavior. Traders across the world, from retail to institutional, watch Fib levels. If millions of people are reacting to, for example, the 618 level, well, the levels become self-fulfilling. Buyers step in, sellers take profit, algorithms react, liquidity builds. You see where I'm going, right? Number two, trading bots and institutions. Most large institutions, they use these models built around standard retracement values, being, for example, the golden pocket. It's baked into countless trading algorithms, being retracement models, expansion models, risk filters, algo rebalancing, quant system, basically everything. This just means that price often returns to the same retracement points because large money is programmed to act there. And that's basically why it works. It just aligns with human psychology and algorithmic behavior. Now, how do we find this golden pocket, this magical creature of a thing that everyone's talking about right now? Let's see. Number one, first thing you want to do is go to the Fibonacci, find the Fib retracement, and you want to favorite that because we are going to use this a lot. And when you found this, this is going to look nothing like what I have here, but it's probably going to look something like, how do I default this? Yeah, it's going to look something like this, right? So you're going to have all these things you have no clue what is. Number one, we are going to get into this in the next video, being standard deviations. This is nothing you have to worry about right now. Only things you need to have on your chart as of right now is going to be the 618, the 786, and that's basically it. And you can also have these two, just so you know where I'm drawing these from. You don't need to have them, I'm just going to use them. I like to turn my background off, I like to turn the trend line off, and I like to use one color, so it's clean on the chart. I also like to remove that. So, this will be your final Fibonacci tool. By the way, do you guys want to see a cool party trick? I can open this bitch with anything. Okay, maybe not my PS4 controller, but that. I know the perfect thing I can use to open it. Does this ruin it? Surely not, right? This should be scratch-proof and shit, right? Okay, this is no longer a hidden talent. I just look like a fucking retard. How the fuck am I supposed to... The fucking Cartier skill, made for multi-fucking use. Alright, so now that you know what a Fibonacci is, you know what the golden pocket is, how can we use this in the market? Number one, you want to identify your swing. This will be just the... Going back to the market structure video, this will just be the higher low to the higher high. This is your swing move. This is your swing point to swing point. This is the impulse move or the range. This is what we're going to use when we draw these Fibonacci tools. Because like I said, the golden pocket fib is a retracement Fibonacci tool. So what you do in the bullish scenario, is that you pull it from the swing low to the swing high, and then you expect retracements around the 618 area. This is where you want to see the higher low get made before going back up towards the swing high, where we can either sweep it or we can create the higher high. Now, you don't want to care if we sweep it or if we create a higher high. You want to be out of your position the moment we take out the swing high that created this move, if that makes sense. You want to be out at this. You want to be out at the zero, always. This is your full take profit. Now, it's going to be the same exact way for the bearish scenario, being a lower high to a lower low, looking like this. This is your impulse move. I will get into examples later in this video, but for now, I just want to show you guys generally what this does. Pull it from the high to the low. This is your bearish scenario. Then you pull it from swing high to swing low. Expecting what? A retracement to the 618 fib after a lower low has been put in. You want to see it go up to the 618 and then retrace back down to create a lower low. Now, again, you don't care if this makes a lower low before going up like this and lower low. You want to be out of your position and forgetting that the markets exist after we take out this low right here. Now, why do we expect retracements up to this 618 fib? Or as the golden pocket, you usually have something like this, where it's the 618 and then you have a 0.66. This is just making that pocket. This is why it's called the golden pocket. Now, you can use 0.65, 0.66, but it's essentially just making a pocket where you expect retracement to go down to and then bounce up from. These zones usually act as a strong support in a uptrend and a strong resistance in the downtrend. Now, why does this work? Again, it's the natural point of healthy correction. And this is usually where institutions like to execute their orders. Like I talked about in the premium and discount video, the institutional traders usually want to see discounted price before they step in with large market orders. And the trend doesn't always go in a straight line up. Like I explained in the market structure video, you want to see higher highs, then higher lows. Then you want to see lower lows and lower highs, right? It expands, pulls back, usually into the 618 and the 65 or 66 zone, before it then continues up to the upside or to the downside, depending on if you like bullish or bearish. And this is why this golden pocket is so fucking legendary. Now, how, again, like, you don't want to just throw this on any given market structure. Again, you want confirmation. You want a strong probability setup. Like I talked about yesterday with initial bounce, you want to see key zones get respected. You want to see key zones get lost. So this is just your very basic golden pocket setup, right? You just see swing low, swing high, pull the golden pocket, expect retracement to golden pocket, and then ATP at the high. Now this is a very simple way to look at it. If you want high probability setups with high win rate and high RR, you want to see something like this, where we see the swing low get put in into a key zone of liquidity, or a key zone like a fair value gap, or a initial balance low get swept, or some sort of previous day liquidity, previous month liquidity, I don't care. Essentially, what you just want to see is a key zone get tapped into with a V-shaped recovery, and then you want to see a change of character if we are in a bearish trend from beforehand, or you want to see a break of structure if we're already in a bullish trend. Now, this break of structure is the confirmation that we want to go higher. And what we do then when we get our confirmation that we want to go higher is we pull the golden pocket fib from the low to the high. And then we expect a retracement down to this golden ratio before wanting price to go back up. So this is essentially what your typical setup will look like, where you'll look for your entries around the 618 area and your stop loss will be below the 786, or if you want to be really safe, you can do it below whatever zone that we tapped into, or even below the swing low that we've created. Now, if you decide to put it below the swing low, you will typically get a 1 to 1.6 RR setup. This will usually be a higher win rate and higher probability, but how I like to trade it is I like to put my stop loss below the 786. Now, you don't want to directly put your stop loss on the 786 because price usually tends to manipulate the 786, meaning wanting to stop other traders out. So sometimes price would like to go down and then just tap below the 786 before going up. So that's why we like to cover it, just like we like to cover the initial balance low in a long setup and cover the initial balance high in a short setup. Same thing goes here. You always want to cover the main factor of the trade. So this is if we want extremely deep retracements before going back up, or essentially putting in a higher low before swapping market structure or something like that. It's essentially just the last hope for the golden pocket to play out. And this will look, again, exactly the same in a bear scenario, where we can say, let's say we have bearish price action. We have the lower low, the higher high, and then we get the lower low again, right? Now we have what? Break of structure. So we have that, and have we reacted off some sort of key level here? Hopefully. Let's say we have reacted here off a fresh 4-hour fair value gap. That's cool. Now we confirm that the trend is bearish by breaking this again. So what do? We pull it from the impulse leg high, or the swing high, to what? The swing low. Oh, that will look like this. And then you put your entry at what? The golden pocket. With what? The stop loss above the 786, or at the swing high, depending on how you like to trade. Me personally, I want to cover the 786. So that will look like this, and then I target this, giving a 3R setup. Now, the good thing about golden pocket and the bad thing is that you can use this on any given time frame. This works on super high time frame. This works on super low time frame. This works on basically any time frame you want to trade. So if you are a swing trader, for example, a crypto swing trader like myself, I love to use the golden pocket to catch continuation trades or catch reversals. I've had so many good trades play out recently just from the golden pocket alone, and I am in several golden pocket trades as of right now in the market that I am expecting to play out. Let's see where my entries is. For example, here on Link, I am expecting a bounce from the golden pocket, right? Same with Solana. I'm already in a trade from the golden pocket, and same with Pengu. Here I am also in a trade with the golden pocket, and on all of these trades, you can see that I have covered the 786 with my stop loss, and I'm obviously, well, targeting higher RR here, targeting higher targets. But what you should be doing is just targeting these highs, especially when you first start out. When you don't know how to read price, I've been trading for 2 years coming now, so I know how to read price action good, and when to let my winners win and when to just cut them completely out. So that's why I like to target, at least when it comes to crypto and when I know where the market wants to go, I like to have these higher targets. Now, I will obviously take some profits at these highs, but I will also let my winners win. By that meaning, I'm letting them run towards what? Full take profit. Now, the common mistakes about people using the golden pocket fib is that they like using it on teeny tiny swing points. We're not going to just use them on any given swing point. Again, you want to see these reactions of key levels. You're not going to just take a random ass leg and then just draw a fucking golden pocket fib on it, just praying it works out. No, then you are statistically fucked. If you want good setups, you need to see everything that you want to see before taking it. So if you don't get that reaction of a keystone, if you don't get a good setup, then you don't take it. Like if we have a leg like this, where it's just a teeny tiny little leg up here, and we don't do anything, and then we make a new leg down, then this isn't really a higher high, or a lower high in my opinion. This is just a fucking part of this entire move. But when we do something like this, and then this, then that is a good lower high to, well, take out this, for example, into, for example, a fair value gap. Now we have this as a lower low, and this as a lower high before going down, and then drawing the golden pocket from this high to this low. I see a lot of traders just try to take fucking trades from this high to this low, expecting that to play out when there's literally nothing that we're reacting from. And then they get raped. Their stop loss get filled, they get stop hunted and turn into fucking liquidity. And that's not what you want to do, right? So that's number one of things you don't want to do. Number two, like I said, follow your rules or follow my rules when you trade this. Don't use fibs without structure confirmation. You always want to use structure to your advantage to catch these continuation trades. Or just overall using these fibs against your higher time frame bias. But alright, let's just try to find some examples here. I'll just use fucking very recent price action. This is literally last week. Now this is going to get a little bit freaky, alright? I'm just going to use previous week's price action as a example, even though this looks like complete dog shit. I'm just going to show you how effective this golden pocket is, especially on the mid time frame, just so you guys can see this for yourself. Now the next video, after next video, I'm going to go over SMTs. I'm just going to give you guys a little sneak peek into this and what it means, just so you guys understand why some of these trades would be good trades. So when we trade NQ, we typically like to trade ES or have ES on the side of the screen. And why do we like to do that? Well, we look for SMTs. Essentially just looking at correlated assets and seeing if they're doing the same things. Like for example here, we can see that ES took out this low, but NQ left it behind. That means we have now a bullish SMT between these two pairs. What that essentially means is that you can basically look at it like NQ also tapped out this low, even though it didn't. That's why we call it a SMT. Now this is just, I'm just explaining this super shortly so you guys understand like halfway why I would take this long. So we have this SMT between here. So that means what? That liquidity has been taken out. And when we have taken out key liquidity into a key zone or key area, like we have all this volume, we have a 1 hour fair value gap that's getting respected, we have a 4 hour fair value gap that's still getting respected, and we're taking out this low inside of that 4 hour fair value gap. So now we then have what? A golden pocket setup. Why? Because first off, we closed above the swing high, right? So now we have the move down, we've taken out a key zone, we have the move up, we have the break of market structure to the upside, and what do we look for after we create the higher high? Well, we look for the higher low. So what do? We pull our golden pocket like this, like here, and what do? We enter on the 618, we have our stop loss below the 786, and what do we target? The swing high. And what do you know? And then again, continuing market structure. We have what? Another close above this swing high. What can we look for? Or actually, I'm going to fully explain this. Again, then we have this move down. We've taken out liquidity 3 times at these lows. Taken out this, finally, and we also took out lower time frame liquidity down here. And tapped into some even lower time frame stuff down here. I remember taking this trade, but I took it down here, by the way. So we have our lower low. We have tapped into a key zone, being the 786 as well. Whilst taking out this liquidity, we create our higher high. And what can we expect next? The retracement to make the higher low. You're starting to fucking get it. We pull it from the swing low to what? The swing high. Hey, fuck yeah. So what do you do next? You enter, oh, my fault. I got a little distracted. So it's from this high to this low right here. Well, I'm gonna do it like this so you guys just see it. I'll remove all this. Sweep off this into the 786 plus this liquidity here gets taken out. Plus, it's probably some lower time frame fair value gaps and stuff here as well. So we have our bounce from the key zone. And we have our market structure break to the upside. So what do we look for again? We look for the higher low to get created. And that means we enter on the 618, stops below the 786, and we target the swing high. Again, like this is so simple if you use your fucking brain. Use all these things that I've taught you. Use these liquidity sweeps, this market structure, and just go down in time frame and find precise entries to follow market structure up. Now I know this looks like shit price action, and it is, but if you really zoom out and you use your fucking brain, you can see that these are playing out time by fucking time. And here too, this is an example that we went over in the fair value gaps video, but we didn't talk about golden pocket entries. So when we talked about this zone, where we talked about this really good zone to create the higher low in the fair value gap video, we mentioned that this was a 4 hour fair value gap that was in discount of this leg right here. But what we didn't mention was the fact that it wasn't just discount we were in. We were in what? The golden fucking pocket, baby. Bang. 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 3R on the fucking dot, baby. Now, why is this a good trade, you might ask? Well, Angus, why didn't you look for a golden pocket down here? Well, I could have fucking done it, but we didn't get a retracement. And we didn't get any good closes over here, by the way. So this would be a bad setup because we didn't really get a close. We didn't get a strong close above. Why would we look for a golden pocket then? We don't have our market structure break. So we wouldn't enter a golden pocket here to enter up. But what you could have done is waited for a golden pocket down here to enter. But that didn't happen. So what do we have here now? We have a lower low, a lower high, a lower low, a now higher high, flipping market structure, getting that change of character. But now you're gonna say, well, Angus, we're not tapping into any key zones. Well, we are. Remember that CME gap I was talking about? Perfect fill of this CME gap, right? So now there's no void of trades in here. We have orders filled in this part of the market, so there's no point for us to go back down here. So that's the bounce from the key zone. And what do we get after that? Well, we get a break of structure. So what do we do then? Pull our golden pocket from the swing low to the swing high, and we enter on the 618, stops below the 786. Now, all these examples are literally from the same week. So this is literally daily setups you can find. If you trade higher time frame, lower time frame, mid time frame, whatever the fuck you're trading, you can literally find these setups play out everywhere on your chart. Yeah, that's going to be it. I'm just going to use this recent example so you guys know like how fucking simple this shit can be. And that's going to be it for this video. And by the way, just so you guys don't get confused, I know I just use bullish examples right now, but that's because we are currently just in a bullish trend. And I made it so simple and easy for you guys that I literally used this last week's price action to identify what I was talking about. For bearish examples, it's literally just the way I drew it up earlier. And you can use the same ideas, just flip the fucking screen around, and then you can see the bearish examples. But yeah, that's going to be it for today's video. I really appreciate you guys watching. It's being a fucking blast. I know it's a pain in the ass to make these videos, though. It takes a lot of time out of my day, but I enjoy making them. So tomorrow's video is going to be about TR pockets. It's going to be the same concepts as deviations, but it's going to be a little bit more advanced because now we're going to put Fibonacci tools into the mix. So yeah, again, appreciate you guys watching. Hasta luego.